Hey, what's up guys, and welcome back to my channel. Today I want to talk about some terminology that I'm sure some of you have heard, and if you are really into economy, basically in this last couple of months, I'm sure you have heard all this terminology. So what I want to do for this video is explain all this so you have a better understanding and a better picture of what we are talking about. You will see all the implications, or you will understand all the implications that all this terminology have in the economy, and some of them in your personal finances. So first of all, remember, if you like this video, please hit the like button, subscribe to my channel, and leave some comments so you can help me and support my channel. So first of all, I want to talk about what is interest rate. So first of all, I want to talk about interest rates, and interest rate from the central bank of the country. In this case, I want to talk about interest rates of the central bank of the United States, also known as the Fed. The Fed actually announced that they were going to lower the interest rate down to 0 or 0.25%. This means that, for example, when a bank wants to get some money, goes to the Fed, asks for a loan, and the Fed is going to give this loan to the bank at an interest rate. Basically, now the bank has money to lend all this to its clients. People like me, like you, or even companies can go to this bank and get that money as a loan. Then we are going to pay an interest rate for that loan. Basically, here the bank is going to charge their own interest rates, and also it's going to add to that interest rate the interest rate at which they got that money from the Fed. Let's suppose that before all these crises started, the interest rate for the Fed was 2%. Now we have to take into consideration the interest rate that the bank is going to charge to their clients for the loan, which is going to be, for this example, 2%. If we add the 2% of the Fed, basically we now have 4% that the client is going to pay for that loan every month. But when the Fed announced that they will lower the interest rate down to 0 or 0.25%, we now have to pay less money for the same loan. We are going to be paying 2% plus the 0.25% that the Fed is charging to the bank. So the bank, the central bank is doing this in order to inject more money to the economy, because it is making money cheaper than it was before. This is going to help people and even companies to have money, for example, to pay their financial obligations, pay their employees, and to avoid bankruptcy. And people like us is going to help us to get loans to spend on the economy. If, for example, I want to buy a house, taking advantage that the interest rates are lower than before, I'm going to get a mortgage at a lower interest rate, and my monthly payments are going to be lower too. And for example, if you have a mortgage already or a personal loan, you can take advantage of this benefit also just by asking to your bank or another bank for a new mortgage or a new loan, and you can pay the previous loan with the new loan at a lower interest rate. Basically, this is going to help to benefit all the economy and to tackle the crisis at the same time. So when we talk about interest rates, this is what we mean, and this is the implications that this stimulus or benefit has in the economy and on our personal finances. Now I'm going to talk about ETF. And basically ETFs are like a basket of securities that have been created, and they are traded every day and during the day in the market as if they were stocks. So you can buy them and sell them without any restrictions. That is one of the differences with mutual funds, which can be traded only after the market is closed. Some ETFs were created to duplicate the behavior of an index. For example, the Standard & Poor's 500 has many ETFs associated to it. So in some way they will behave or mimic the behavior of the index. So we can find, nowadays we can find many ETFs, for example, ETFs associated with bonds or treasury bonds, corporate bonds, industry bonds, currency, and commodities, for example. we can buy those ETFs that in some way are like a basket of securities, and by doing this I'm buying assets from these companies, and it is a good way to diversify my investment in the market, and at the same time I'm going to reduce the risk of my investment. So ETFs are really well recommended because of their return yield, and also their associated costs are relatively low. So when we talk about ETFs, we talk about a small basket of assets that we can buy in one single purchase from one single industry or different industries. We are going to diversify by doing this, and at the same time we are going to increase our chances of making a good investment. Now I want to talk about bonds, and I'm going to talk about government bonds and corporate bonds, which are bonds of companies. So basically, when we talk about bonds, in some way we are talking about loans that we make to these entities. Investors make these loans to make profit, and these entities can have access to cash and cover their financial obligations. These entities will pay down the value of the bond to the investor plus an interest on the bond. That's the way investors make money from buying bonds. So for instance, the treasury bonds from the United States are a secure way to invest money, because they will always in some way or another pay off the loan, and that's why they have a good rating. The same principle applies to companies. They offer corporate bonds to get some cash to make investments or improvements, and they pay down the value of the bond plus an interest. Companies as governments have different ratings, meaning that entities with higher ratings will have more chances to pay the loan than entities with lower ratings. In summary, there are government bonds and corporate bonds, depending on whom we lend the money to. They use this money to make investments or improvements or pay their financial obligations. So they will pay the money back plus an interest rate, and these entities have their own ratings, which is a tool investors use to understand how risky the investment is going to be. So now I want to talk about futures market. For example, I'm going to talk about the oil barrel that is traded in this market. We knew that the price of the oil dropped down to negative prices because of the low demand and the lack of places to store the product. All this because of the crisis that we all know. Basically, what happens in this market is that there is an agreement to buy and sell a product or financial instrument at a specific price on a specific date in the future. One use of futures market is to allow individuals to navigate risks and uncertainty. Prices are always changing, but with the futures market, people can lock in a fixed price to buy or sell at a future date. Locking in a price lessens the risk of being negatively impacted by price change. So, for example, with oil, when prices go up, it will benefit the seller, but when prices go down, it will benefit the buyer. With oil markets and oil futures in this case, both are able to lock in their prices ahead of time, which in turn will benefit both parties. In the futures market, you can trade oil, gold, or commodities, for example. And to finish, I want to talk about the repo market. In this market participate banks and big companies, and they lend money to each other in a very short term. We're talking about weeks or even days. To understand this market, let's consider Bank A and Bank B. Bank A has a lot of cash in its vault, and Bank B has securities that could be stocks, for example. So Bank B needs cash and will go to Bank A to get some cash, but in return Bank B has to give an equivalent number of stocks to Bank A. The agreement is that on a specific date, Bank B will buy back those stocks to Bank A at a higher price, and this is the way these companies make money through this market. If, for example, Bank B cannot buy back these stocks to Bank A in the specified date, Bank A will take ownership of the stocks. To give you an example of how important this market is, in September last year, these companies stopped lending money to each other, resulting in a lack of cash, leading the interest rate to go higher and making it harder to get cash. When this happened, Wall Street started to drop, and the Fed had to step in to help recover this market. When they made this announcement, Wall Street started to recover. So, like I said, we can see how important this market is and the impact it has on the economy. So when you hear people talking about repo market, basically they're talking about this market in which banks and huge companies get together to lend money to each other. Basically, these are some of the most common terms that we use when we talk about this last crisis. If you like this video, please hit the like button, subscribe to my channel, and leave comments about the topic of this video and future topics. Thank you and have a good one.